Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, will the stock market level off at some point and turn range-bound? And what impact is the lower dollar having on stocks going forward? Our analysts weigh in. Editor-at-large Steve Reitmeister, stock analyst Tracy Reinick, and market technician Kevin Matris, fresh back from being on the road.
Yes.
I might add, we should do a feature, On the Road with Kevin Matris.
Nice. Who'd watch that? Nice. Everybody.
Same
They
people
watch me lose money.
Same people who watched when Charles Kuralt was doing it, I guess. Well, look, there's a lot of people out there now saying that as we move into the holiday season, while the focus still remains on the consumer short term, longer term, even though the market's bias remains to the upward side, that 2010 could bring a new reality for stock investors. Something that was alluded to here on the roundtable a few times, the range-bound stock market. And I'm going to start with you.
Okay.
What do you think about that, Steve? Is range-bound in the cards here going forward?
Or range-bound or modestly up. You know, it kind of reminds me of, like 2003 and the market that happened after that. In 2003, the market was up 29%, which is, a gangbuster year. Mm-hmm. But really, in the years that followed, it was still a bull market because it didn't really go down, but it was modest gains of 5 to 10% per year. And I wouldn't be surprised to see that going forward. So this was our big gangbuster year, rebounding from bottom. But don't expect that next year or the year after. I think that range-bound or modestly up market is quite likely.
So, Tracy, would that be a good or a bad thing if the market settled into a trading range here? Might cause for a yawner of a year, but is that necessarily bad if the market takes a step backward and takes a breath?
Well, after the crazy 2 years we've had, that might not be a bad thing. But I think a lot of it will depend on what the Fed does. And if they're signaling they're going to raise rates or that kind of thing might impact where we see the actual market going. Also, I think a lot of the companies have to come through with revenues going into next year. That could impact a little bit more maybe in the second half of the year, that we could actually see, I'm a little more bearish, we could see it turning down maybe next year because of, those two things combined. But, as Steve said, once you have a big upward, rally like we've had, it can't keep going forever. And next year, it's going to either retrace back or trade sideways, something. But we're also seeing a lot of the money that's slashing around out there going into these other areas, commodities and things. But it is also going into stocks because we've seen the stock markets worldwide going up. So these are all, that ties back into if we see a lot of the central banks tightening, what happens with the money going into all these asset classes.
Kevin, you look at the charts on a regular basis.
Right.
Could this be a real reality here, sideways for the market for an entire year?
I don't know if it's going to go sideways. I do believe it. At some point in time, we're going to have to see a correction. But if you were to look at the move that we have seen this year, it is not outside of the average gain that you would typically see from the bear markets. If you were to take a look at the top 10 bear markets over the last, I think, 100 years, the average move from the low is, I believe, somewhere around, I had some notes here, I think the average, 55.6% exactly. If you were to then look at the average move over the next 3 years, it's around 77%, and then over the next 5 years, it's like over 100%. So I don't know if we're going to necessarily be flat over the course of the next year or two. These numbers do suggest that the returns won't be as spectacular, but I do believe that you're going to probably continue to see the market try to ratchet higher, because if you were to look at the earnings yield on the S&P, the earnings yield on the S&P is about 6.25%. If you were to look at, the 10-year, for instance, it's just a little bit over 3%. So people are chasing yield, and really, stocks right now, it's kind of like the only game in town to be able to get any kind of yield. And it's not just here in the States, it's everywhere else. There's so many other stock markets around the world.
Tracy brought up something when she said a moment ago, talking about the Fed. and their stance on interest rates here in the new year. That's a big concern out there because there's a lot of people, analysts and investors, who are saying that the Fed's taking way too long as far as forming an exit policy or strategy from all of the stimulus that they've thrown into the economy. And keeping interest rates low is a big thing, which is depressing the dollar as well. So
Yeah, I mean,
is that necessarily a negative thing at this point?
right now, well, it goes both ways, right? Because investors like certainty, and right now it seems pretty certain they're not going to raise for quite some time. I mean, the earliest people are saying is like next fall. It could be 2011. Some people are even saying 2012. So as long as they feel like they know the program, then they can put their money where they need to put it. So that's not necessarily a bad thing, except that the money seems to be going maybe in some places a little crazily than it otherwise might go if they had some fears that the policy was going to change or something. That's why I think a lot of people want the Fed to at least start telling us when the exit strategy is going to be.
What do you think? Would you rather know when the exit strategy is going to take place, or would you rather just play it by ear?
Well, Bernanke, supposedly, he has said the clarity from the Fed is incredibly important, and he wasn't trying to dismiss what Greenspan had done over his time, but Greenspan was definitely a little more ambiguous in his statements. It wasn't always clear where he was coming from. But Bernanke, he tripped people up at first because he meant exactly what he said at every stage. And if you really follow through what he has done, he has always followed through on exactly what he said he was going to do. So therefore, we know we have a Fed chairman who's going to signal what's going on. He said recently, we're going to keep him here for a while. I suppose he will. And which kind of makes sense because they're much more fearful of deflation than inflation. So they've got to make sure that we get past that one. And then when they think that that boogeyman's done and now we're starting to worry about inflation, then they'll start to raise the rates.
Right. Kevin, what do you think? Lower dollar going to have a negative impact on stocks here? Going to maybe put a cap on stocks' ability to move significantly out of that 10,000 level?
At the moment, the lower dollar is helping the stock market. You have all of these companies who are able to find their growth coming from overseas opportunities. And the falling dollar is making, our foreign customers, have that much more purchasing power. So I believe that the falling dollar, as long as it doesn't collapse in a spectacular fashion, if the dollar all of a sudden collapsed, that would be bad for not only the U.S., but I think the entire world economy. But if the dollar starts slowly going lower, that does make all of our goods and services more attractive to foreign consumers, and that is what's helping us out tremendously. So I actually hope that everything stays very stable and there's a very orderly decline. At some point in time, somebody's going to have to do something to try to support the dollar, because if it goes too low, that is going to derail it. But right now, it is a big benefit.
Do you agree with that?
Yeah. The point is that if you take a look historically, strong dollar and strong market usually go together. So right now, for the things that Kevin pointed out, it's not so bad in the short run. It's kind of like one glass of wine a day is healthy for you. Okay?
If it's red.
Right, if it's red, okay, and it cleans your blood and all these things. Right. But what's happening is, and right now we're in the 1 or 2 glass a day variety, okay? But if we keep lowering the dollar and we get to 5, 6, 12 glasses a day, that's when it becomes a problem, okay? And that's what some people are fearful of. So right now it's only a glass or 2 a day with the dollar dropping. We can't afford too much longer over time because people will not want to invest in our country if they don't think they're going to get the money out.
All right, we're going to leave it right there for time. Thank you for being with us. That's it from the round table, and you can keep an eye on Zacks.com's homepage for any updates on commentary as far as the markets are concerned and other economic movement. With everyone here, I'm Terry Ruffalo.